Hey guys, thank you for tuning in. If you're new to the channel, welcome. I hope you would consider subscribing. We are building a community here of people who are interested in insurance in superannuation and hopefully spread the word to help people understand what entitlements they have within their superannuation in respect of insurance. And if you are a returning viewer, thank you. Really appreciate the support. In the past few weeks, we've been talking about what you need to do to make the most of your insurance when you're joining for the first time or if you've just joined your employer. Today, I want to focus on what you can do if you're already a member and you wish to increase your cover without underwriting. But before we get into that, I think it's worth understanding what underwriting is. It's one of the most common words that you would hear in addition to premiums and claims. So underwriting is what the insurer needs to do to assess your risk. And it often requires you to provide satisfactory evidence of good health, salary details, and other information. And by other information, I mean things like your hobbies, your family history, your income. They will certainly have an impact in the insurer's decision to offer you insurance. And for medical information, you would normally be required to do blood tests, go to your doctor, fill in lots of forms. It's inconvenient. So if I could help you find a way to increase your cover without having to provide underwriting, then I have added value to your day so far. There are a couple of ways you could do this, and most funds actually offer these options. A, increasing your cover by uplifting it to the next level on first joining your fund. This doesn't happen all the time. It's only on you first joining. B, increasing your insurance through life events cover if you're about to go through one of the specified life event triggers. So let's dive in and check out the whiteboard video, and I'll come back at the end and wrap it up. So let's talk about how you can increase your cover without underwriting. One way to increase your cover is to uplift your insurance multiple as soon as you join. But this is only possible if there is a range of options offered to you. For example, if your insured cover is based on your salary, one of the most common benefit calculation formula is percentage of salary times future year service. The percentage can range from 5, 10, 15, 20, or 25%. Typically, a mid-range level of 15% will be the default provided, and you'll have a window period to respond if you want the higher levels. If you do take advantage of the window period, you can usually request to uplift to 20 or 25%, and you will not be required to be underwritten. But coming back to the future year service, what is this, you might ask? It's usually calculated as the period between your age at the time and the date you would have ceased work to retire. If you're 40 years old today, then you still have a long way to go. If we used 85% as salary for our example here, based on a 15%, your default level of insurance is around $344,250. Of course, if this is enough, then you don't have to do anything. But if you still have a lot of financial commitments, then you may wish to consider the higher levels of cover based on 20 or 25%. Another common type of insurance benefit calculation method is to have a fixed amount based on your age. For this example, we will refer to these as units. With this type of cover, it is important to understand that the value of each unit can change with your age. It could significantly drop when you get to the next age band, but the number of units you have generally doesn't change. If there is a range of options offered to you when you first join, then you may wish to take advantage of the uplift offer. Similar to the earlier example, if the default is 3 units, then you can choose to have 4 or 5 units instead. This means if you choose not to do anything, you'll still have the default of $300,000, but if you're asked to take advantage of the new member offer, then you can have up to $400,000 to $500,000 without the need to go through underwriting. The other way to increase your cover without underwriting is through life events cover, also known as guaranteed future insurability. This feature started in the retail space and slowly found its way within the group policies, but take-up has been very low because people either don't know about it or forget that it's there. It is a feature in your policy which allows you to increase your insurance cover based on a number of specific life-changing events. The most common triggers include marriage, having a child or legally adopting a child, or when your child starts school, or buying your first home, or death of a spouse or a partner, or divorce or separation. These events may vary between different funds. For example, some policies only allow tertiary schooling as a trigger event and not primary or secondary. There are also other conditions you need to consider. Your application for increase must be made within the window period of the event occurring. You must already have cover, and any special terms that apply to that cover will also apply to your life events cover. There may be a limit to the amount of increase you can have through life events cover. There may also be a limit to the number of times you can apply for life events cover, usually only once every 12 months. Your life events cover may also be subject to limited cover conditions and suicide or self-harm exclusions in the first few years. Other points that you should note: window periods can vary between funds. This can range from 30 to 120 days. The offer to uplift or take up cover above the basic or default cover can also vary between funds. It can be offered to you as any amount you nominate within a limit rather than constrained by an age or salary-based formula. This all depends on what your fund is offering you. You should be aware that not all funds offer a range of cover level options, and cover obtained without underwriting will usually be subject to pre-existing conditions, limited cover provisions, or a 13-month suicide or self-harm exclusion. Therefore, if you're in good health, it's better to be underwritten so that the cost of your cover is more aligned with your specific risk profile. Okay, hopefully you found that video useful. Even more so, I hope your fund offers the uplift capability and life events cover so that you can request to increase your insurance arrangements. A couple of things I wanted to point out. Hopefully you're seeing a pattern in these videos. The key thing is, if insurance is important to you, you cannot just rely on default arrangements because they are not designed for you. You need to engage with your fund and understand whether the default arrangements that they have in place is the right insurance arrangement for you. That's it for this week. Thank you for making it to the end of the video, and if you're just passing through, please consider subscribing and maybe passing the link on to other friends and colleagues who might be interested in learning a little bit more about their insurance arrangements in their super. See you in the next video.